Hello, everybody. Welcome to this webinar from the Law, Finance and Technology Group at the University of Hamburg. My name is Georg, and it's a great pleasure to welcome you to this pre-Christmas edition of this workshop, the December edition, if you like. We're very fortunate to have with us today Professor James Grimmelmann from Cornell. Thanks so much for joining us today. Professor Grimmelmann is teaching at Cornell Tech and at Cornell Law School, so he's really at home in both worlds, trying to bridge the two worlds of technology and legal scholarship. And I understand sort of trying to bring the two communities into a mutual understanding. He has a very interesting CV, in case you didn't know. He used to be a programmer with Microsoft before he started an academic career. So he really knows what he's talking about. And at the moment, I understand that you're on a sabbatical, James, so even more fortunate that you took the time for a quick break, coming over to Germany, no, I'm joking, and speaking through what marvelous technology to us, which of course has downsides, but is also so great in facilitating communication across countries, and it's great that you can join us here today. The topic couldn't be more interesting because it's on central bank currencies, an issue which is of course hotly debated also in Europe, and we very much look forward to your thoughts and your insight into this topic. For everybody, it's a great idea to mute your microphone, but I see that almost everybody is doing that. So you are invited, if you like, to switch on your screen, however, because we always like to see faces. Please do engage in discussion and everything after the talk. So James will speak for about 20 minutes, and after that, we have enough time for discussion Q&A. That's it for me. Over to you, James, and you can now, I think, start your screen. Thank you.
Great, thank you. Thank you for inviting me, and thank you all for coming. It's a pleasure to talk to you. Please pardon any interruptions or shouts from my kids in the background. That's what I'm spending most of my sabbatical doing. But they've given me a short break to come and talk to you today, and I hope we can make the most of it. So this talk grows out of a paper that I helped write a very small portion of. This is a report produced primarily by the Institute for Cryptocurrencies and Contracts, which is a multi-institution effort, strong Cornell presence. And this is a report about central bank digital currencies. So could a central bank like the US Fed adopt a digital currency for broad adoption that would shift from cash to something maintained digitally, with a very strong emphasis on blockchain technologies and what they might have to offer or might not have to offer. So I really thank you for your very kind comments about my background, but much of this is above the pay grade at which I can comment in detail on the technological choices. That's what my colleagues are experts in. What I know is law. I'm a very small brain, but I do know a bit about that field. So what I'm going to talk today about is what my section of the paper, the legal section, covers. And I'm going to focus on things that people don't always talk about when they talk about law and digital currencies, and some of the constraints that those put on design choices, particularly the design choices when you have a central bank or a governmental agency thinking of whether to adopt one of these. So I'm going to just talk very briefly about central bank digital currencies, and then also very briefly about some familiar legal issues, which are the kinds of ones that come to mind when people talk about digital currencies. And then I'll spend more time going into some issues that people don't talk about as much. And my goal is to just to set out how the US legal system deals with a lot of these issues. Other legal systems are broadly similar, but vary a lot in the details of their commercial law. but I'll go through basically what people come out of law school in the US understanding about these systems, and then think a bit about how those interact with the design of something meant to enjoy broad adoption among businesses in a country. And then some closing thoughts about what this says about how we design digital financial systems. So let's start with the CBDCs, central bank digital currencies. And it's helpful to parse this in outwards order from the currency, which is the noun, out through all of the adjectives modifying it. Currency is just something that circulates that people use to pay for stuff. And here's this common definition that talks about its different roles, but really the essential piece of it here is that it's used for payments, that the currency is meant to circulate and be used by people and businesses to pay other people and businesses for things. It can be goods, they can be services, but the point is that it provides this medium of exchange. And so people will want to do their transactions. And we have a wide variety of things that work as currencies. So we have cash, and then we have a whole variety of payment systems built atop of this. The payment systems started with paper checks and banknotes and have evolved to a wide range of systems that people currently use to pay for stuff. And of course, it requires coordination. The payer and the payee have to agree on using a particular system or they won't use it. So there's a great value in having common systems that are easy to use and widely adopted. There's also great value in making those systems digital, that if you don't have to circulate paper artifacts, everything can move faster. You can also verify the bona fides of the person paying you. So the checking system is transitioning from a system based upon the literal movement and cross-checking of pieces of paper to one that processes only images, to one that does entirely like digital transactions with no piece of paper at the start. That functions as a digital payment system. A digital currency would be a translation of something closer to cash, in which there are units, and these units have some fixed digital identity, and they can be transferred from one person to another in a conserved fashion. So if I have 6 squidloos, I can give you 3 squidloos to buy my hamburger, and now you have some balance of 3 maintained in some digital form somewhere. It might be on the accounts of a bank, it might be in digital certificates that you yourself hold, it might be on a blockchain, but the point is that there's a conserved-ish quantity of these squidloos circulating that we can use to pay each other, and the system as a whole is responsible for the integrity of keeping the payments in balance and keeping the accounts balanced. A central bank digital currency is simply one that is sponsored or issued by a central bank. And the central bank has a bunch of fiscal policy missions. It's designed to make sure that there is a value circulating. It has a whole bunch of roles in providing stability in the financial system and society. But having a currency is simply a tool that it can use to advance those policy goals. A lot of the design considerations I'm going to talk about apply equally well to any kind of digital currency. The main thing I think about as a central bank is it by definition has a certain set of missions towards its society. It is tied to a particular country and its legal system. So there are a whole bunch of legal issues that get talked about an awful lot in the digital space. And you can probably rattle this off even if you didn't have the slide here for me to show you. So there's jurisdiction, which is that the internet is worldwide, so anybody can log into and use one of these systems, even if they're not in a particular jurisdiction, which makes it difficult for that jurisdiction to hold them to its laws. It can be good or bad from your perspective. If you are thinking about things like anti-money laundering laws, then, well, it's probably kind of bad if people can get around those laws and use digital networks to smuggle the proceeds from violent drug trafficking. If you're thinking about it as a matter of financial privacy, you might have a different perspective. Jurisdictions care about being able to enforce their tax obligations on payments, and they have a bunch of systemic rules about trying to make sure the entire system is stable and doesn't defraud consumers. So the general heading of financial regulation, FinReg. These are all fairly familiar debates because there's a lot of effort paid to well, does this particular initial coin offering have to comply with the securities laws? Are you running a bank if you do an exchange for a blockchain-based currency? I am not going to talk about any of this stuff. These debates have been done extensively. People have done great work. People have also done terrible work. I'm not going to get into it. Instead, I want to talk about some more basic day-to-day considerations that people who use any payment system worry about. So let's start with all the things that can go wrong. There are a whole bunch of ways that somebody could make a transaction, have it entered in a payment system that do not correspond to some intuitive sense of a transaction that ought to be honored. You could start with the disloyal agent, that the company's treasurer, who has the authority to issue payments to vendors, goes and just cuts a check to himself. If they have credentials to the Bitcoin account, they send the Bitcoins to their own address, they disappear, and they enjoy their newfound wealth from a tropical nation. There's also impersonation. The hackers get access to your mobile phone, they figure out your private key, they drain your wallet. They issue checks pretending to be you. They do something that steals your electronic credentials. There is straightforward mistake. You mean to send a transaction to the following address, you got the wire transfer form all ready to go, you transpose two numbers and it goes to somebody else's account. They were not the intended payee, but the system doesn't know that. How do you get your money back? If you're doing this in the context of something with better checksums, like a blockchain-based transaction, maybe you searched for the recipient's account and you got the wrong one, or you simply cut and pasted the wrong digital address when you were finalizing the details of your transaction. These things happen. More nefariously, you've got various kinds of fraud. US law typically distinguishes between fraud in the factum and fraud in the inducement. Fraud in the factum means somebody actually forged a transaction. They created a document that purports to be you transferring them title to your house. In fact, it's just a complete forgery. They forged your signature. Or they shoved a piece of paper in front of you and told you, sign this. This is the authorization for me to come and wash your windows. And in fact, it was a forged deed to transfer your house. Or there's fraud in the inducement where they say, okay, you pay me $100 today and I'll come back tomorrow with my tools and get it started on work, and they skip town. There's a lie, but the lie is not about the identity of the document itself or its contents. The lie is about something else. Here, give me some money, I've got a miracle cure. Then they disappear with your money. So there's a whole range of things that can go wrong with transaction. And the thing I just want to emphasize is that not one of these is visible in the actual transaction records. Whatever system you've got, all of the facts that make these transactions mistaken or fraudulent are off ledger. You have to know something else about the context to know that this was not intended by a fully informed payer. So what does the legal system do? Well, it has a whole bunch of rules worked out to deal with these, but to give the overview summary is pretty often tries to unwind the transactions. There are different rules. You can say that frauds are avoidable, which is the payer can fix the transaction if they realize the fraud before things get too out of hand. Whereas outright theft is simply void. It's kind of as a nullity. Anyone downstream takes bad title to the stolen assets. You can't get a thief to give you title to a stolen car, no matter how far downstream you are. If the police find it, it will be returned to the original owner. There's some attempts to protect innocent parties. So people who actually steal always have to unwind it and give back what they stole. If you're just the innocent person who bought a watch from a store, not knowing the previous owner had engaged in some shady dealings to get it, you might be allowed to keep it. It will be a problem for people upstream from you. But the general point is that the law is going to try to unwind these transactions if it can. So what does it want? It wants to have clear rules that tell people who use a payment system or any kind of asset system when they can rely on a transaction. You can talk about checks clearing. Well, this is the idea of at some point, the transaction is actually solid enough to be relied on. So you want a rule on finality that says, under these circumstances, you, the user, can trust that this is a legitimate transaction. It wants negotiability rules. It says, if you have a $10 bill that you got as change when you bought some groceries, you can trust that that is actually valid currency, and you won't get told, oh yeah, somebody stole that in a mugging 2 months ago. You have to give back that $10 bill. Cash is negotiable. It's not subject to claims like that from upstream. So the legal system wants to have rules about when it will and won't unwind transactions. And it won't enforce these against digital assets. It's also going to want infrastructure to manage this. If you run a payment system, the law is going to want to have some way of having a judge come in and telling you, who do we send the court order to unwind this transaction? And for some kinds of disputes, the law won't even try to get involved at all. It'll say, hey, Visa has rules on when it will issue a charge back to a merchant. Visa makes the merchants agree to that. It runs a dispute resolution system that handles a lot of these. So currencies that want to be in wide commercial use may need both a management infrastructure and their own way of handling disputes among payors and payees about when the transaction should be unwound. Beyond that, it's also going to want to know what happened. If you and I have a dispute over a payment that you say you made and I say you didn't, we're going to sue each other, and the law is going to want to know, was this payment actually made? It's going to want authenticated records from this system. So it needs some way of getting relevant state out. And more than that, it's going to want to know things like IP addresses. If there's a fraudster running around, what addresses were they using so they can be tied to the fraud? I don't have any great answers on what all of these rules ought to look like, but the one I want to point out is that every existing payment system in wide use has all of these. You take your wire transfer, you take credit cards, you take any of these systems, and they all have built-in rules. The rules are different for many of them, but they have rules that govern how all of these questions are answered. That's topic one. Topic two is secured transactions. If you borrow money, you can give the borrower a lien on your property. You don't just promise to pay back the borrower. You say, if I don't, you can take my stuff. And you tell them which stuff they can take. So that if you buy a car on credit, the lender has a lien on the car. If you are a tractor dealer and you are selling tractors, your local bank will probably have a lien on your inventory. If you stop paying them, they can come to your lot and just take the tractors back and sell them. So the lender can collect the collateral in case of a default. And also there's priority in bankruptcy, which means if your entire business goes under, they don't need to wait in line with all of your general creditors and get pennies on the dollar. They just take their tractors back and call it a day. And this is part of what makes small business loans work. Businesses rely upon these loans to have enough capital to have in their inventory, to meet their payroll. This is basically what keeps many businesses in operation. And one of the things that makes lenders confident enough to issue credit is that their liens trace into the proceeds of a transaction. When the tractor dealer sells a tractor and gets a check from the buyer, whoever had the lien on the tractor now has a lien on the money in that check. They keep their lien as it changes through various forms to the assets of the business. That way, the tractor dealer can't just have a fire sale of all the tractors, get a bunch of cash, and then say, haha, you can't collect from us. It's part of what makes the lending secure. So if you're a lender and your business starts saying, hey, we want to take credit payments using this new blockchain thingo, you get a bunch of questions. You're like, are my liens still going to work on this thing? Or is you just open up a loophole in the entire system to let you smuggle assets out? If you stop paying me, how do I collect this blockchain thingo? Where do I go? Who do I ask for? How do I get it? If you stop paying, and I know you've got the account there, How do I lock that account so you can't drain it before I get in it? With a bank, I can send them a letter saying, yeah, the court has told me I'm entitled to collect from this account. Do not let the account owner make transfers out of it. And also, how do I tell other people this blockchain thingo now belongs to me? I have a lien on it. Don't you go taking it, claiming you didn't know about my lien. Don't you go issuing your own loans against it, claiming getting your own liens. I have priority. So they want to know about these things, or they're going to be very concerned about trusting this use in the business. So these are two problems of private law. And I want to submit that a lot of the usual arguments in favor of cryptocurrencies and the revolutionary potential of new technology for finance really run aground when you try to make the private law stuff work. People talk pretty regularly about transforming the entire system and saying, legal system, like we thumb our nose at you, you can't control us. Lots of systems have done this. And it's an open, serious question whether they can get away with it. But that question is practically irrelevant in the world of commercial law. People who use payment systems, who use the banking system, rely upon the security the legal system provides them. If you pay by check, you pay by credit card, you have a lot of backstops in case something goes wrong. If somebody steals your checkbook, there are systems you can go to that will cut off the risk, the danger that somebody could drain your account. Somebody forges your name on a check, that check is not properly payable. You can cite those words to your bank, and the bank is not entitled to drain your account to make those payments. Same thing with your credit card. Federal law limits your liability for unauthorized purchases. You want to use a wire transfer, you got many fewer protections. You have some, but you have fewer. Businesses use them, consumers don't. Consumers should not make wire transfers that they don't know what they're getting into. But the businesses that make them are exceedingly careful. They have to have countersigned multiple authorizations from somebody inside the business to do them. They have procedures they follow where they double check every digit before they make a transfer because of the risks. Is Joe's Corner Groceries going to make a lot of transfers with a system that has even fewer protections than a wire transfer? Joe's Corner Groceries is not going to touch that thing for anything of significant value, and they're not going to touch it for things of small value either, because it's just not worth the hassle. As long as they have user-friendly systems that have payment protections that match their like non-techie, non-sophisticated profile, they're going to stick with that before putting their money into something where it's all at risk if they make one mistake. And creditors too are not going to be interested in these new systems if they find out that they can't either legally or practically collect on their loans in case of default. They do not want to hear that, yes, you have technically have a lien against this blockchain asset, but yeah, good luck getting the miners to cooperate, and how are you going to get the private key to get it back? That is not something a lender likes to hear. They are going to forbid their borrowers from taking payments using this system if they think they can't collect from it. So this is basically to say that there have been a lot of debates about new finance technologies and blockchains and other things in terms of public law. The state versus the individual. Here we have a bunch of rules and you comply, you do what we tell you to. But that's not how private commercial law works. The essence of commercial law is about creating a framework that lets people enter into transactions together. Create a sense of security that's justified enough. People will put their money at stake and trust other people in business dealings. People have real problems doing this. There are things they want, and they are going to be genuinely concerned about mistakes and fraud. They're going to be genuinely concerned to arrange commercial loans so that they can have an inventory and sell tractors. None of that stuff goes away with a new financial system, unless you can create people who are capable of never losing private keys or never having them stolen. Unless you can create people who take the perfect diligence required to use one of these irrevocable, no refunds, no backsies cryptocurrencies, people aren't going to be able to achieve the level of care the system expects of them. See, if you're going to design a digital currency and want it to be widely used, you need to interface with the systems the law has for solving these kinds of problems. And these are not arbitrary rules. These are things that have been worked out over centuries as rules that respect and protect people's autonomy and their ability to use these systems securely. Some of these rules might need to be changed. They might not be well adapted to the digital age, but the underlying point of having these rules is basically sound. Figure out what people need to be able to enter into these deals in some respectful, trustful way, and then facilitate that. And I want to submit to you that if you're trying to design a central bank digital currency, it's probably going to look a lot more like these traditional systems than than like these more ambitious, really pie in the sky efforts, because the traditional systems are better adapted to interfacing with the protections that the legal system provides. All right, that's my presentation. Let's have a conversation.
Thank you so much, James. That was extremely thought-provoking and refreshing. Also, very, very nice to hear your children from time to time. That makes a bit of a real-world touch. But no, that was great. It's interesting because it echoes some of the points that we had in an earlier talk. Also on the going in a similar direction, pointing out some of the limits of the new blockchain world, which will be subject to some of the challenges that are unexpected and don't really fit into our legal system as we have it at the moment. So can I invite everybody to join into discussion, and if you like to ask any question to Professor Grimmelmann, then please either raise your physical hand, that's the easiest bit maybe, or use the chat function or anything else like that. I'll try to moderate, and maybe while you're thinking about what to ask, let me start with the first question. So, James, I mean, your main point is that basically we need to have an adequate protection system for users of currencies, otherwise they will not use it, right? Then I guess two questions come out of it. One is, should we worry then, right? Because if people are not using it, then what's the problem, right? So it should be in the industry's self-interest to provide for those safeguards, otherwise nobody will use it. That could be the first point, sort of to push you a little bit on your argument. And then second question might be, isn't the digital currency world already trying to do that? I mean, for example, are they using smart contracts and distributed ledger technology is really trying to address the fraud problem by having those decentralized ledgers where, which are not easy to be corrupted. And so I guess there are already private devices that are trying to address the problems that you have outlined. So maybe those two questions are maybe something to kick off the discussion.
So the first one is it's an eternal question in banking and consumer protection law, which is what's actually necessary to provide confidence. In many situations, if people are flocking into something, then it's indicating that they have confidence in it. So one traditional response is that sometimes the confidence is actually unjustified. That's the point of securities law. People will pay money to promoters who are engaged in outright frauds, and that's simply wrong. We should prevent it. And the broader argument is that it may look like it's popular now, but if we want really, truly widespread society-wide adoption, it has to have real gold standard confidence. And so early adoption by people who are more willing to take risks is not necessarily a sign that it's suitable for widespread adoption. And I think that for many cryptocurrencies and many digital projects, it's appropriate to solve for the early adopters now. But if you're designing a central bank digital currency, you have a higher standard of what you want for confidence. So central bank, this is the case where the CB actually comes in as a design constraint, that they probably have higher standards than the industry might. On the second point, about the industry taking protection, I think to think about the blockchain or distributed ledger as protecting against these concerns is to protect against a subset of them. There are a set that involve corruption of the ledger, and it's actually extremely good about preventing that. There are mining attacks, there are issues involving potentially collusion among miners, but putting those aside, it's very good at protecting the records. And that's something that traditional systems sometimes get wrong, that you have a fire in the land records office burns down. Well, you've got kind of a problem. With a digital system protected worldwide with stronger guarantees about the integrity of the chain, you've got better protections against things like that happening. But as I think a lot of these cases that people are worried about are more like insider attacks than outsider attacks. And we don't just protect against the forged check, we also protect against the authorized insider who issues a check and embezzles funds. And that depends upon the specifics of the relationship between the principal and the agent. That's something that's external to whatever system they wind up using. You can't put the full details of their authority and their employment relationship into a smart contract, at least not anytime soon. And so as long as there is a portion of the world that exists outside of your chain, then you have to worry about how you secure against risks that come from that part that you haven't formalized. And so my point of view is basically, there's always going to be, or for the foreseeable future, most of the world will be off-chain, and therefore you have to interface to the rest of the world.
Okay, excellent. Now let me hand over to people who want to ask questions. So Alessio, you come first.
Okay, thank you very much, James, for your presentation. And indeed, I find very relevant issues of civil law if we want to achieve a safe payment system in the future. And I also think that these questions already arise about cryptocurrencies, and especially the case of Bitcoin can be very illustrative. But you focus on central bank digital currencies. And indeed, I would like your comments in distinguishing clearly among centralized and decentralized cryptocurrencies, because these can have a huge impact also for the design and the governance of the currency itself. And talking about centralized, like the case of central bank digital currency, eventually, digital forms of money, I would expect then also a greater role for public authority in the governance of the ledger itself, for example, and maybe also in dispute resolution, although this may raise all new questions of legitimacy in our democratic system. To use the example of the alliance, because I couldn't find one for fraud and mistakes, maybe one solution could be the establishment of the new authority, somebody responsible to collect as a smart contract forms, for example, different agreement between parties, maybe trying to safeguard their anonymity, I don't know. But indeed, this could create more frictions to do easily business. And indeed, this connect to your last comment, that is, you're finding that is you cannot provide a payment system which is not friendly for businesses, for example. Otherwise, nobody would like to use it, because indeed, the payment system are at the end a platform market, I think. If you can maybe build on the centralization issue, thank you.
Yeah, I think so. There's a sense in which a central bank is just going to inherently drift towards a more centralized system. Given the deep investment of a state in creating and using a currency, there's not a lot of additional value in having it be truly decentralized. I think they're going to want to maintain a lot of the dispute resolution authority, a lot of the decision to make policy changes to the functioning of the system if they have to. Just given the various missions that they play, you can see them choosing something much more at the centralized end. There might be some distributed elements to it, They may not maintain all of the sole authoritative copy themselves, but you're going to have things from the centralized end just given their mission. In terms of meeting the needs of users, this is where a lot of intermediaries and things built on top of an infrastructure come in. When you think about what retail banking is, one part is connecting to financial systems. Another part is talking to people and explaining things to them and helping them use it. In the same way that you see in the cryptocurrency space, there are exchanges and wallets and other things that are built on top of a chain. You can imagine that there is new technology, new whatever, inside of a system, doing a lot of the back end work. But the user-facing layer looks much more similar to what we have now. You have more apps, you have more businesses, you have more things that are not your crystalline crypto utopia to interface with actual people. I'm not sure it's a world-transforming change to shift from having traditional financial technology on the back end to newer stuff. I think the retail, like meeting people where they are part, is not likely to change really dramatically.
Thank you. Next comes Pedro. Would you like to?
Yes, I can join. I have a few questions. Quite interesting talk, and I really like the paper. My first question is a little bit on that, so I'll try to be short on that, so we can move on. The first one is that you, as you said in the beginning of the presentation, you're also thinking on the framework that CBDC has this will be based on the blockchain. And the first question goes on that, and a bit related to Alessius, which is all throughout the paper and your chapter is always you don't give a final answer. You talk about all the possible pathways that policymakers might have in designing the central bank digital currency. So you kind of conflict a lot of them, especially like the ones that you jump here that's a bit more traditional to debate is compliance against privacy and so on. But even the ones that you brought, you also have always this choice. Right, so my first question is a bit on that. Society also changes in preference, and then we change in how we want the payment system to look like. So we might move from maybe today we have more privacy concerns, maybe tomorrow not that much, or the opposite. So how far is it able for us to keep doing those changes if the CBDC will be implemented in a more robust system, like which is kind of bulletproof to those changes? So that's one. I had one that you talk about locking, and when I was reading the paper and also through your talk, I think about like a lot of the potential that locking might have. So CBDC might enhance this on you guaranteeing that certain assets go to the certain accounts and so on. So I was thinking about the potential of using this enhanced capacity on bankruptcy procedures. So I was just curious about if you have any comment on that. And the last one I had was one that's brought by, you probably know him, like Koning, John Paul Koning. He has a paper on debating different types of payment. And then he brings a little bit of that debate, like, why would you move to CBDC if credit cards have so much more protections and so on, and wire transfer not that much? So you have this difference in security, which is super important for consumers. And one that he proposes that that maybe in the future we could also be allowed to differentiate price. That business would be allowed to, like, if you want to pay with CBDC, you pay X, and if you want to pay with credit card, you pay, which is the surcharge debate. And then I was thinking, like, do you think that could also play a role that that maybe okay, they won't be as safe as a credit card, but maybe cheaper? Those are the 3 points I had. Yeah.
Yeah, I think take the surcharge debate last. I think this has traditionally been an area where the different payment systems lobbyists have fought it out. And I can certainly in business-to-business transactions, it makes a lot of sense that they should be free to arrange it as they want. That if you say, please pay me by wire transfer, like that's just what you expect your people to pay, how they pay you. And that's, if you don't want to deal with that, you don't buy from them. So stepping backwards, which was the first question, which was the second?
The first one was on the possibility of changing preference on the design of the
Yes,
payment.
change over time. And the second one was?
On the locking and bank resolution, yes.
Yeah, so changes over time. I think this is an area that, again, promotes centralization. This is something, it's an issue that we see again and again with blockchain systems, where you have to have consensus on what protocol you're running and any changes to it, which is there are constantly needs for adaptations and changes to how the system works. You find bugs in the software or bugs in the protocol. People decide that design parameter choices about the number of units or about particular ways it was tuned are wrong. There are more fundamental debates about what the purpose of a given feature is. So you get governance debates all the time. And I think it's a mistake to think that you can lock in a system that is future-proofed. You can design something that's robust and can adapt and has some flexibility, or you think that's a good, clean design. But there's constantly this need for people to say, oh yeah, we screwed this up last time. Let's fix that now that we understand the problem better. And all these systems go to fake. You have to design it with the expectation that it will either be amended or simply replaced at some point in the future. And your system is not one designed to last for all time. So that cuts in favor of centralized systems. In terms of locking, yeah, I think that that's one of the functions of bankruptcy. Bankruptcy is one of these key events where you just want to freeze things in place and deal with it and figure out what's going on. And I see this as a strong reason to design the system in certain ways. There was a question in chat about anonymity. Some debate starting to take place there. So let me surface that because it's an interesting set of questions. Again, taking the commercial law-oriented perspective, there's not really a strong interest in privacy in a lot of these systems. Not in anonymity, because you have people generally want to know who they're transacting with and want to have some guarantees. Yes, trust could be used as a substitute if all you care about is getting paid, but businesses also want to know, are we taking a payment with laundered funds? And they might generally want to, we want to be careful about that. There is a privacy interest in the sense, not in the sense of personal privacy, but in the trade secret sense, that we want to be able to enter into certain deals without our competitors knowing exactly what we're up to and anticipating it. So this is why you can't just go and as an individual get all of a major technology company's payment records. But there are a lot of cases in which the need for anonymity is nowhere near as strong as crypto advocates would say. That if you look at how people use something like Venmo currently, they seem to be quite comfortable broadcasting a large number of personal details about what they're doing to not just the user system, but basically to the world. So that's a pretty strong evidence from the actual use that people do not feel that anonymity and privacy are a strong component of what they need from this system.
If I could actually just jump in on that, I'm one of Dr. Grimmelmann's colleagues. And I've actually worked on a cryptocurrency system before. That was a previous job of mine. As I was saying in chat, there is this common mistake, I think, among people who want to have cryptocurrencies, the understanding that the belief that consensus algorithms can somehow can replace human trust. Our trust in the banking system is based on things like reversibility of transactions and of physical protection of assets, for example. That's one of the major things when you're designing a cryptocurrency system, as we were. We were looking at what wallets could be used, which wallets were safer, what could prevent a cryptocurrency holder from being physically assaulted, which happens in some cases, and having their currency taken from them. And those are things that, as Dr. Grimmelmann was talking about, are built into these long-standing systems of, financial trust That's not the same thing as a bunch of calculations saying, yes, this is the transaction that it said it was. Those are not the same things, and to assume that parity is a mistake, in my opinion. But I'd love to hear what Dr. Grimmelmann has to say about that as well.
Yeah, thank you. I think, yes, the physical assault danger is a very real one. And of course, there's a certain mindset which says basically the answer to any real world problem with a technological system is to make the technological system larger so that it just solves that problem by bringing it inside. So don't just have protect people from the physical risk by giving them complete anonymity everywhere they go. So that means they're walking around wearing facial recognition defeating masks everywhere in the real world with nothing traceable about them. Or we stay entirely inside our cells in isolation, and we send out untraceable digital agents to do all of our work, and we never meet anyone in person and have no physical bodies. And if we upload ourselves, then there'll be no physical identity to be compromised. So we can solve the danger of this by simply replacing ourselves with robots. And you see where this goes. And this is the totalizing tendency comes up in all kinds of systems. You're like, oh yeah, we don't need to worry about having security for physical capital if we get rid of physical tractors and just live entirely in the cloud. So yeah, again, it's like a matter of like we are people. We inhabit the physical world. We have dealings that are not easily digitizable, and any sensible financial system has to meet people where they are.
I know, James, if you're keeping an eye to the chat, but somebody with the name of Alexander, who unfortunately doesn't have a microphone, commented on your point and sort of made the point that actually a blockchain-built currency could even be more trustworthy in some situations than in a human-built financial system.
Yeah, so I would disagree with Alexander's claim that the greatest required trust is to prevent double spending. That's certainly an essential element of trust, and that is one thing that's required to make the system reliable. But I think from the point of view of a user, you also want to prevent the single spending problem, which is I have some asset and somebody else spends it on something they want. I want to be very confident as a user that I will not have my funds drained. And that's not something you can solve just by putting it on a blockchain. You can have something that requires a private key to make a transfer. But this becomes an interface problem. I have an asset. I want to spend it on the thing that I want to get, and I don't want to spend it on something else or have somebody else spend it for me. So I need to have some mechanism I can use to authenticate this transaction under these circumstances in this amount for this thing. Well, whatever mechanism I have to do that becomes an attack vector. And you're designing not just the details of the chain, but an entire ecosystem to make me able to make these transactions without unacceptable false negatives or false positives. That's a more complicated design problem. Again, blockchain technologies and the use of crypto to secure these choices can be an important part of the solution, but it can't be the only part because you have all these human factors and social factors that aren't reducible to the cryptography.
Great, thanks so much for picking this up. So I guess at this point in the discussion, it's maybe worth looking a little bit into the future. So I'd be curious as to, recap. So I got the main point of critique from your angle. So what would be your solution, if there is one? I mean, what could be the best way of designing a trustworthy digital currency or a central bank powered digital currency? What would you recommend lawmakers to do in order to make that a commonly used device?
So again, this gets into issues that are outside of my area of expertise. I know about technology. I know about technology law. I know a bit about property and commercial law. I am not going to say that I am a deep expert on financial regulation and on the details of banking or securities law. I'm also not going to say that I'm an expert on the design of database systems, secure systems, distributed ledgers. There are lots of things here that involve considerations that I don't go beyond the sphere I know about. My perspective from the sphere that I know about suggests the following, which is, I do not think that a central bank wants to set up a system that relies upon individuals and small businesses to handle all the technical details of interfacing with it. I think that that is too heavy a lift for the kind of adoption a central bank wants to get for a widely used currency. I also don't think a central bank wants to be in the position of running a retail payment system. That's not what they're good at. It would require them having lots and lots of people working for them, handling customer service. I locked myself out of my account. Can you help me, please? Help me understand how to work the interface for this. That is not something the central bank has competency in. Their expertise is done with institutions. You put that together, and it pretty much suggests that they are going to want to do one of two things. One is going to do something very much like what they have now, which is to maintain a back-end system for substantial financial institutions to interface with the central bank and with each other. Maybe that transitions from being a database that the central bank itself maintains and that it has essentially in-house to some kind of more federated system that they have a smaller role in, some of which is built on new distributed technologies. Or maybe they run something that is actually designed for retail users, but relies upon other institutions in the financial system, existing banks, existing payment companies, to handle the user interface part of it. That they want to have somebody else do the retail end of it while providing the standardized, widely supported system that will happen, that will engage in it. So imagine more interoperable apps than we have now with the central bank's intervention, making them where they can emphasize policy directly against accounts. You can imagine one of those two worlds. So I see something where they have some role, but also some kind of other institutions sitting between them and the users.
All right. Pedro, you had another question.
Yes. So is somehow related to your last answer as well. And I was curious about, so a lot of the narrative that comes to justify CBDC is a countermeasure to the growth of stable coins, especially, and also an answer to a project that is might be released next month, which is the Libra project from Facebook. And exactly on another point that you on your talk was this capacity of correcting some issues of the current payment system and how can we update that. So I'm just curious about what your take between this confrontation between this private payment system and CBDC. How we both interact, and also on the two sides, on like evolving systems, like which might have a better take on being corrected and updated and solve these issues that we're presenting.
Yeah, and again, this is me partly out of my depth in terms of the details, but payment systems are examples of these things that have enormous, enormous network effects. There's enormous value in having widely supported ones. But because of that, they get very entrenched, and it becomes hard to make changes to them without a lot of buy-in. And so you get this kind of leapfrogging effect, where somebody has a dominant system that becomes so widely used, in fact, it sticks and does not change much, which leads it to become out of date with people's needs, and then you have something that jumps ahead, and you get this big discontinuity. And this kind of can happen in different places at different times around the world. So the central bank is basically in a position of trying to create a system that won't get stuck in that trap.
You have to say to them, you put that in a bank vault, right? Or you put that in a safe. Otherwise, this money is completely gone and there is no recourse. And people would say, what? And it was not a concept you could communicate to people. It was because they assume so greatly that, significant amounts of money and savings will be put in some place that is already physically safe, right? So that was a massive, massive challenge to adoption. And similarly, as Dr. Grimmelmann was saying with QR codes, actually one of the things that many cryptocurrency wallets, I think, are doing that could is driving better adoption than, say, encrypted email, is that they don't require the handling of keys, because keys are long, long strings of numbers that are very confusing and intimidating looking to people. So, you know, with encrypted mail, if you have to handle your key, it's a much significantly harder practice in many systems than transferring cryptocurrency, because you do have those QR codes. So there are some simple things at the basic level of interface that also are going to, you know, drive or limit adoption as well.
Let me tell a story. One of my friends who's a lawyer told me about Bitcoin and cryptocurrency assets. He had a client who had $200,000 in Bitcoin stolen. I guess that's a rather small number of Bitcoins now. At the time, it was a larger number. But even like the client says, I had this stolen, and the exchange where I was storing this didn't secure them properly. Like, we're going to sue them and get my money back. And so he goes and he investigates. They send their usual lawyer letter to the exchange. The other side's lawyers come back to them. They have a meeting, discuss over what their positions in the evidence. And at the end, they go back to the client, show the client what the exchange came back with, and the client says, oh, yes, that was completely our fault. We didn't secure our key properly. Nope, they're right. We're just out $200,000. Oh, well, thanks anyway.
Well, on that pessimistic note, maybe it's a good moment to close this event because we're at time. Thank you so much, James, for this wonderful talk and very thought-provoking and really challenging some of the key assumptions. Thanks also, Jillian, for coming in so vigorously and for the engaged discussion to everybody. This was really a nice event, and we're very grateful to you, James, for making the time. All best wishes to your kids. Go back and have a look. Happy holidays to everybody and a good Christmas. We look forward to having you joining us again at our next event in January. Until then, have a good time and stay safe. Thank you very much. Take care. Bye-bye.
Thank you, Georg. Thank you, everybody. Now I'm going to take my kids out for the snow day.
That's good. Have fun. Bye-bye.